Tornado. Oh no, Pete. Sorry to hear that.
Dang, yeah, I was just reading that too.
Okay, you are live.
All right, team. Welcome to the webinar here. Today is August 7th of 2020. I want to welcome you all in and thank you for taking the time to join us here live. My name is Dean Gallagher. I'm an investment consultant and partner here with the firm. Thank you for taking the time to join us here today, folks. We're going to go ahead and cover all of the positions that we do have and also talk about the new positions we just added yesterday. Okay, so folks, on exactly 6/22, okay, which is 32 trading days ago, when I was onboarding my new staff here of investment consultants, we now have 7 more team members here at Portfolio Builder. What I did is I helped a bunch of complete newbies, guys, build out a beautiful structure in their portfolio. Okay, so at that time, we actually allocated $800,000 specifically at that time, and since we've grown some profits, we've added a little bit more money to that. Okay, but from June 22nd till now, which is exactly 32 trading days, we've been able to grow the account by $112,000. Okay, and 107 bucks. So 112,107 is the total overall profit. The most recently added positions are going to be Moderna. Okay, and also silver. Okay, so those are call options. Those come out of the boot camp. That's where we deliver our high alpha trades. Okay, and then we also have our put protection here, but these are our core asset classes, and that's what helps us deliver a little over 111,000 bucks in the past 32 trading days. Okay, so that's a quick update on the portfolio. I didn't see any changes, Jason. Is that correct?
Yes, that is correct. No changes today.
Okay, cool. So yeah, so folks, if you are new, what you're going to be doing is simply building out the portfolio structure. Okay, so Jason's going to cover that here in just a moment here, folks. We'll tap into that and we'll show you guys how to build out this exact same portfolio structure that we've been using to safely grow our capital at just a phenomenal rate with Jason's help. So with that, team, I'm going to go ahead and switch it over to Jason here, and he's going to talk about the portfolio setup. And so if you're an existing client of ours, no changes today, guys. But if you are new, you haven't built out the portfolio, we're going to walk through those changes today. So if you are an existing customer, no portfolio changes today. But if you haven't structured the portfolio, and I just saw Nav jumped in there, he's one of our newest pro members. I saw Crystal jump in there too. They're one of their newest pro members, guys. This is the work you're going to want to do to get your capital into the tank here with the assets, protect it with the force field here, okay, and then be set to jet. All right. And once again, guys, that's what the makeup looks like for what we're doing. And then if you have less than 50K, guys, this is going to be what you're going to want to build if you have less than 50K today. And you can build your tranches per either 11,000 if you have under 50K, or if you have more than 50K, you're going to build your tranches per 25,000 bucks. Okay. So just want to make that really clear for you guys. Pro portfolio, we do tranches of 25,000. Okay. So you can build as many tranches as you want. Okay. And that's, most customers there have at least 50,000 or more, and the buy and hold can be built if you have less than 50,000, folks. And that's how we've been helping our customers. So with that, I'll let Jason take over and we'll start the official presentation.
Okay, thanks, Dean.
Thank you, Jason. Appreciate it.
Very good. So I'll start off with reviewing the trading plan and then hop into the questions. But I see William's nervous about gold. Well, as long as the bond market's behaving, we're going to have no problem with gold. And so there's a little bit of fear around the Democrats and Republicans not getting a stimulus plan out. So that's one thing we'll talk about today. Paul Scott says something unexpected happens. Will you be talking about the TLT? Oh yeah, we talk about the TLT every day. That's half of our portfolio. Paul Scott, just here to listen. Tino calling in from Houston. And Tino's up 5.3%, just added 15,000 yesterday. Very good for you. And we have Swycord B calling in from Tallahassee. Very good.
Yeah, and Jason Tino joined last week, so he's done that in 1 week.
Nice. Very good. Yeah, Bill Richardson says bonds, equities, gold, puts, crypto, everything's down. Only thing up today is the dollar. Yeah, we'll cover that. So yeah, we had a 6% return for August yesterday. We've lost a little bit of that today, but the fundamentals of the market has not changed. So hang on to your horses. No changes. We'll cover all this and more with our presentation today. So let's start off with a quick review of how to follow the trading plan. Then we'll jump into what's affecting markets, as we all want to know what's going on. Okay, so per $25,000, you buy 200 shares of TMF, 100 shares of UPRO, 100 shares of UGL, and 200 shares of FCX. What are these? TMF is a leveraged product giving you exposure to the 20-year treasury. We're not interested in the yield it makes per year. We're interested in the government expanding its deficit, and the only way it can do this is by driving yields lower. So this does represent the largest position in our portfolio and how we're able to make money when stocks go down. Just remember that if stocks go down, bonds go up. And we'll show you that risk parity strategy, how it works in a moment. Okay, next position is UPRO. That's a leveraged ETF playing the S&P 500. It has your favorite tech stocks like Amazon, Facebook, Google, but more importantly, it also has the beat up industries like airliners, energy companies, banks, telecommunications, utilities, everything really is quite beat up. So the SPY provides the best hedge for the bond position. Now, next we have UGL. That's a 2 times leveraged gold product. So playing spot gold. This is really a protection against the dollar being debased or devalued. The increase in the money supply is the fastest in history ever since March, and they're nowhere near done printing money. Now, could we have a little bit of a stalemate in this current month going into the election? Sure. But at the end of the day, this whole economy is going to collapse if we don't keep printing money until we have full employment and get this show back on the road. And we're nowhere near getting this show back on the road, as I'll show you soon. So we want to remain long bonds and expect that the government has no choice but to keep printing. So we're protected against a short-term crash in stocks with half our capital being in bonds. We're protecting against our currency being devalued by owning gold. And we're positioning for a recovery with UPRO. And then meanwhile, the copper position is really an extra. So we have about 5% of our capital playing Freeport-McMoRan, FCX. It has a, you could say, a monopoly. It has the largest share in the copper mining industry, and it's the ultimate inflation hedge. So what would kill everyone out there in the market? Too much inflation. Why? That makes central banks hike interest rates, and then you end up crashing bonds. If we crash bonds when we don't have a strong economy, then you're going to crash your stock market and gold while you're at it. So copper is a critical hedge. And as I do see the right policy changes at the local state levels, and we start to see pickup in transport, we're going to slowly get out of gold and get more heavy in the S&P 500 as well as copper. So that's the big plan here as we get ourselves out of this mess. Okay, next step, we're going to look at the force field. So this builds you a tank. Now, I would say if you just own bonds, you'd be something like a dinosaur, nice and slow moving. Now, that's not to say that bonds haven't been a great investment for the last 40 years. But they're still slow moving, and most people don't have that in their portfolio at all. We have half our capital in there at all times. There's only one event that would change that, and nobody from our investment consultant team answer this, but if you know the answer, post it in the chat. What's the one event that would cause us to dump bonds, and what would likely have to happen before that event would occur? So not only do we want to help you catch the fish, we're going to teach you how to fish in this webinar. What's the one event that would make us want to abandon our bond position? Okay, Rick says I'm going to add another 25K to the portfolio. Yeah, just follow it. So yeah, you want to have a humility to the market that there's chaos that you can't predict. And that's why we have half our cash in deflationary assets and half our cash in inflationary assets, which does make this very safe to jump into at any point in time. I don't care how high any certain assets given. Okay, we got the answer. Alex says yield curve control. Very good, Alex. Now, what would cause the Fed to roll out yield curve control based on the last two instances where the Fed took significant action? And those two periods are March of 2020 and quarter four of 2018. What happened to which index to cause the Fed to capitulate and change policy in a dovish manner? What index has to fall by what percentage before we've seen action taken? Okay, so it's the S&P 500. The Federal Reserve believes that the S&P 500 is critical to trade at a high level in order to spur economic job growth. So they will almost at any cost protect the S&P 500 if it has a significant sell-off. So we've seen them actually get quite frightened with a 30% sell-off twice now. So this is what I'm expecting would be the action for the Fed. Now, what would happen if the S&P 500 did sell off 30%? Which assets are likely to go up in value in this current positioning? Well, the bond position is going to take off to the horse races. We have half our money in that. UPRO obviously would get sold off, which will lead to step two, how we protect against that. The gold position would likely go up because we're going to predict that this government's going to come in with a couple $1 trillion more of stimulus and that bond yields are going to go lower, which means the real return on the interest rate on a bond is negative. And right now, the 10-year Treasury's real yield is negative 1%. So that's why people are starting to buy gold instead of bonds. So most likely, if we did get a stock market crisis, which perhaps Nancy Pelosi is trying to design right now, then what would we expect? Bonds go up 50% of your account, gold goes up 25% of your account, copper and stocks go down. That only represents 30% of your account, but it gets better. What happens if those assets really do crash? Well, good news for us, not only are the underlying assets protecting us against that crash, we've built what Dean's nicknamed, and I love it, the force field. So this is the tank. Okay, you're not flying around in a motorcycle. So people playing tech stocks, and that's all they've got, are essentially running around on a motorcycle without a helmet. People are playing precious metals without any other assets, I would say are more akin to flying a airplane, even though you don't really know how to fly an airplane, very dangerous. And again, people playing bonds just all on its own are also at a great risk. It's really critical to perform this full portfolio at the same time and build the tank. Each asset protects one another. Now, what's protecting your bonds? UPRO and copper, but not gold. So we'll get into more of this as we go through the presentation. Just realize this is an extremely safe allocation of capital where each asset is designed to protect one another. Now, the next step is to add a whole nother layer of protection. So we have a large insurance policy at all times protecting every single asset. Even though each asset's designed to protect one another, the various positions also have put options below. So we have what I would call life insurance for each of these four assets. And in fact, if we were to crash below the strike on any one of these assets, we'd actually net a profit on the losing asset. So we have a lot of protection for a large crash in any one of these four assets via our put option insurance. Now, uh, the positioning up above protects against small moves. The positioning down here protects against large moves. So it'll be very, very hard for us to have a large loss in our account over the course of time because of the way we are positioned. Now, funny enough, the bigger risk, if we do pass a stimulus deal and start to reopen the economy and realize the pandemic's been greatly overdone and that vaccines are coming and that we really shouldn't have never locked down the economy, well, then we actually may have a completely different risk in our hands. Imagine the bond market starts to sell off. Now what's going to happen? Well, UPRO is going to go up wild. Copper is going to go up wild. But if the yield on the bonds going up at a faster pace than inflation, all of a sudden bonds become very attractive. And now gold's in trouble. So it's just not as simple as being single-minded with your strategy. And you really have to look at a four-dimensional puzzle here to make the right moves in this very distorted market. So we're doing a good job of that for you and trying to teach you the different outcomes as we go. Now, if we take a look at your positioning, for every 25,000 invested, you have 45% long the 20-year treasury. Again, we're not trying to collect the yield on that. We're trying to bet that yields must go lower for the government to continue supporting this economy and to make a profit for the investors of US treasuries. So that does remain our favorite pick, especially heading into a very rough election. Next step is we have 25% of our capital in S&P 500, 24% long gold, 5% in the copper miner, and then we're investing about $500 a pop on insurance. Now that insurance typically provides no value until something really bad happens. So imagine you get in a car accident, you know, that hospital bill could have been $50,000 to $250,000, but because you're paying your little insurance policy, you only had to pay maybe $5,000. So the put options can not only really protect us against bad things in the market, they can actually generate a larger profit if we get a large enough crash in any one of these assets. Okay, so final thing is I do want to mention that we have extra trades on Thursday. Specifically, we're playing Moderna, which I believe is the best vaccine to invest in. I'll cover more of that why, or more about that during this presentation. And silver. So again, we do have a large precious metal portfolio already, but silver has the potential to just astronomically take off if we get a run up like 2010 and 2011. So we're playing both of these with out of the money call options. They're very risky. You don't want to actually own the underlying asset in large quantity. What you do want to have is a 1 to 2% maximum position that you're rolling over on a weekly basis to play the phase 3 Moderna trials, which are underway right now. And we should start getting good vaccine results from that testing coming up in the following weeks. And then the same thing for spot silver. Now, eventually I'll get more aggressive with copper once we see the right policy happening at the state level. Currently, that's just not happening. Plus, we may be at a roadblock on new stimulus, which could be something that upsets risk assets. Okay, so that boot camp also includes education. So not only will you get bonus trade alerts that are designed to add extra alpha to your portfolio, you're also going to get options trading education. So we have 5 modules you can immediately jump into. Plus, you're going to get about 3 to 5 hours of content to study every Tuesday, which I call the weekly study guide, where I find all the best interviews of the people I respect and study. And then on Thursday, we cover that material. We present the new trade alerts and we do live Q&A. So if you do want to join the boot camp, there's also bonuses for those of you who do upgrade to try it out for 30 days when you get your advisory. Now, we also have a easier portfolio to follow. Per $1,100, you would buy 10 shares of UPRO, 10 shares of TMF, and 5 shares of SLV. This is very similar to what we're trading up above, but I'd argue slightly riskier. And so typically with our buy and hold clients, they're keen on a little extra risk. This does not use options to trade the market. So we have to be very careful with positioning. And as you'll see, we have half your capital in bonds, half in the S&P 500 with just a little taste of precious metals for you. And that portfolio is actually doing quite well today. Okay, so let's look at our report card and then we can jump into more content. I'm also looking for questions as we go. Post those questions, guys. This is a great time to learn. Okay, so we had a also, I do want to point out, you can also go to the spreadsheet and tap through all the different tabs and see every trade we've ever put out, including all the open positions, which again is really not something most advisories do. What do? They, first of all, they don't have a set amount of capital. So they're just firing off trade alerts, hoping you will figure out the right position sizing, even though position sizing is really the most critical aspect of this risk management, right? So in July, we had our record-breaking 9.5% return. August, we jumped down to 2.3. So we were sitting at 6% yesterday. Everything was melting up. Today, we've had a smorgasbord of odd news, which I'll cover, and it's confusing markets. Main thing is the dollar's gone up and everything else has sunken slightly lower. So we did give up a few percentage points in August, but still extremely confident in our positioning as the fundamentals just have not changed. And so we'll cover that shortly. Now the buy and hold portfolio is sitting on a 3.6% return, has less exposure to gold, more exposure to the S&P 500, and it has that tiny spot silver position. So the buy and holds also performing quite well this year. Okay, so let's take a look at what's going on in the markets and causing these moves. Okay, so first of all, gold to copper ratio predicts the future of yields. And right now it's pointing straight down. So that's very good for our bond position and what I actually expect through August. Now, if we can't come up with a stimulus plan, then I would expect both bonds and gold to go up, despite gold really being a benefactor of government stimulus, as that's supposedly going to create inflation. But as long as we do drive yields lower, I think gold's going to be perfectly fine. Now, why is the gold copper ratio so effective at predicting interest rates? Well, when we're building things, copper is a key commodity that's purchased. When we're debasing a currency because there's economic turmoil, then gold rallies. And so that ratio is very good at predicting whether we're in a recovery or we're still in a downturn. And so this is clearly showing that we're still in a downturn. And that's why we have this ratio pointing down, which would mean our bond position should travel higher from here. And again, that's critical because we have half our cash in the bond portfolio. Here we have the yield curve. Once again, we're playing the 20 and 30-year treasury. This has the most leverage for playing interest rate changes and is again our most confident position until we do get a full recovery or yield curve control. More importantly, the 2-year has really been the main leading indicator of where treasury rates are. And so with it trading at 0.11, there's a huge room for further suppression of yields in the bond market. Also, once we go look abroad, we're seeing other countries' yields go into negative territory. So this is very good for the US to be able to compete in the bond market and have an attractive bond to sell at these very low interest rates. The inflation picture is still way below 2%, their target. The last two prints have been 0.6 and 0.1. If we get too much inflation, the central banks will have to hike interest rates, which are detrimental to stocks and bonds, perhaps good for gold. However, if we have too little inflation and go into deflation, then all of a sudden you end up in an environment where everyone wants to save their money because they think if they wait, the prices of assets will decline. So that's what you ended up with in 1929 through 1934 with the Great Depression. And so we're potentially going to risk that outcome if we can't reopen the economy and restore all the job losses that have occurred from the pandemic. And so it's not quite clear how many of the businesses that are now being shut down and filing bankruptcy can be recovered and how long that will take. Because when you lose one job, that can create a loss of 3 other jobs, and 3 other losses creates 9. It's a domino effect. So we've wiped out every restaurant, we've wiped out every bar, we're wiping out all the theaters. It goes on and on and on. So there's a massive problem here. And the only way to solve it in the short term is printing tons of money. So that's why we still like that bond position, even though we are starting to see signs of a recovery. Now, this is the cost of money. The Fed picks the interest rate, and then this is where it goes from the top down, from the Fed to the big banks, from the big banks to the medium banks to the small banks. Bottom line is the effective federal fund rate acts as a magnet towards US Treasury interest rates. And as long as it stays at 0, I would expect our bond position is going to do just all right. Now, right now, they're not anticipating hiking interest rates for several years. In fact, that's till 2024, 2025. So that's very good for bonds. However, if we do get a panic in the S&P 500 and we drive the yield on the Treasury down below 1, all of a sudden it becomes questionable how much lower it could go. And that's when the Fed would have to do yield curve control. They can't afford for everybody to dump the treasuries and spike yields. So that would be the ultimate move for gold and tech stocks. If we were to see another crash in the S&P 500 by 30%, expect to see us rotate into probably a silver tech combination with lots of put options to protect, and potentially the best returns of this advisory in its history would occur after that. With the current setup where we're trying to recover, where it looks like we may get this show on the road, I really like the less risky setup with the S&P 500, spot gold, and then the large bond position, because we still have room for bonds to go much lower before they have to do yield curve control. Here's the Treasury's balance sheet. So it's skyrocketed up, but has been flattening out. They're on track to grow this at $1 trillion a year. But the key words from Fed Chief Powell's last speech was not that they will continue the current purchase of $80 billion a month. What they said was that they would do at least the current purchases per month. And that's very important wording. That means as all this debt starts to roll over and we're going to have to start spending more and more money we don't have, that the Fed is ready to buy up all that debt and start growing its balance sheet even quicker. So that's very good for bonds, stocks, and gold right now. It's bad for the dollar, and it's going to start putting pressure on inflation, which is bad for the Fed trying to keep interest rates lower. But they are willing to let it go above 2% inflation for quite some time. So we get an average symmetrical 2% inflation rate. So right now, it's going to be quite hard to create inflation when everybody is jobless and has no money to spend. They're barely able to pay their rent and to get groceries for much of America. So that's not going to create a lot of price inflation on the CPI index, at least. Now, this is my favorite chart to show people. Everybody thinks stocks just go up, but that's just not the truth. And if we go back to this chart, this is something Ray Dalio will teach us. You have 10-year cycles and you have 50-year cycles. So what do we see in here? Well, we see these little 10-year cycles. Okay, crash, boom, crash, boom, crash, boom. But it ended up with a general 50-year cycle where they had to hike interest rates all the way up to 18% to get all the bad investments out of the economy, to get all the inflation out of the economy. And that's what set us up for the last 40-year cycle. So we've had nothing but lower interest rates for the last 4 decades, driving assets up the entire time. But what happens when you bottom out at 0, 2%? Well, that's exactly what happened in the 50s and 60s. They bottomed out at the 0% twice. Nixon ended up depegging the dollar from gold, and we had runaway inflation. So that's really what we're on the the edge of here is we're coming through deflation. If we can get out of this slump, what's going to happen is you potentially have rising prices because you printed so much money and now everybody's getting back to work. And what's going to happen to the cost of goods? They're going to go up rapidly. So that is what gold investors are predicting is on the horizon. And what's important is that they're also predicting that the Fed is going to have to keep this interest rate at zero for several years. In fact, for the next half decade, because of the bad shape of our economy. So we're basically predicting the Fed is stuck printing money and keeping interest rates low. Yeah, food inflation's up about 10% during the pandemic. Harriet asks, is there rising prices at the supermarket? Absolutely. And there's actually been a shock, a big demand shock for food because all the restaurants are closed down. So you have to go shopping now. Okay, so what happens when the Fed loses control and they have to change interest rates? Bad times for stocks. So look at what happened to stocks in 1965. We crashed for 15 years. If you bought stocks in 1965, you didn't break even till 1995. 3 decades of lost returns if you didn't know what you were doing. Okay, now that's the picture of inflation. If we get deflation, that can be far worse. Now, back then, they weren't so clever with printing money to try to spur inflation. But what happens if everybody loses their job? They're going to be scared about the future. So they're going to stop spending. And that creates a demand shock. Now the prices of houses and everything else start to drop because no one's willing to buy anything. And as they see those prices dropping, well, why not just wait a few extra weeks or months to make that purchase, see if it goes a little lower? So that becomes a self-fulfilling cycle too. So both are really bad, but the 95% crash in the Dow in the 30s is the worst in history. Now bonds did great during that, but again, those are the 2 periods of time we need to be very careful about with our portfolios going into retirement. Okay, so talking about currency pegs snapping. In the boot camp, we're also shorting the Hong Kong peg, which, by the way, Carrie Lam just got put on a banned list for having taken away the rights of the Hong Kong people. So that's the right direction. We also got the news that the US is going to force Chinese companies to do the same accounting practices as US firms, which again, they can't by the way the Communist Party's government works. So we're about to get all of the Chinese equities out of here. So this is all fast forwarding towards what we want to short the Hong Kong dollar, which is the trade that could potentially return. If we get the Hong Kong peg to go from 13 cents to the dollar down to a penny, that would create a 10,000% return, 100 to 1 return. So we have investors sitting on that with a 1% position. It could take a long time to pay out, but if it does snap, the potential return is to double your net worth with only 1% of your capital in play. It's a very patient trade. We'll look at the news. It's happening in our favor currently. The last time a currency peg snapped was in 1970 when Nixon depegged the dollar from gold. And look what happened to the value of gold. So I do think the same thing would happen to the Chinese currency if they tried to stop pegging it to the dollar. So that's the last time gold did this with the dollar, and we're on the verge of creating a snap between the Hong Kong dollar and the US dollar currently. Here's a look at copper. Important to note, in the 2008 recovery, had this huge shock in copper prices, and I'm seeing that same pattern develop in this rebound. So that's the ultimate inflation hedge to protect your bond portfolio. And we're not playing it with spot copper. We're actually playing it with the copper miner. So as this goes above 3, that copper miner is extremely profitable. And if we look at Freeport-McMoRan, it had a 500% gain in the 2009 rally. Okay, Treasury is currently still picking up 80 billion a month, and they're moving that from the front end of the Treasury curve towards the long end. That means they're going to be supporting the very product we're holding, so that's always comforting. The Treasury is expected to start ramping up debt issuance as we have a lot of debt rolling over that has to be resold. and they're trying to push it from short-term debt into longer-term debt. In the next 3 months, all of these pretty predictable offerings are going to increase in quantity by about 10% slowly. So the Fed has indicated that they're willing to also increase their purchases. So that'll be very good. Here's the Fed's balance sheet. We check every Thursday. And again, just pretty much flat, no big changes in their balance sheet. The repo market is another form of quantitative easing, but this is more related to when we're not doing quantitative easing. So we're seeing zero stress in the repo market, zero dollars being borrowed. So that's again showing our banks are not under any threat currently. Now I want to look at the pandemic real quick. So what I have in the blue line is the rate of change, and the white line is just the case count. And so we're looking at whether or not in the major economies of America, whether or not the case count and death count is rising or falling on a 7-day rolling average. And what's that change of pace? Is it increasing or is it slowing down? Is it accelerating or deaccelerating? And so in New York City, it is deaccelerating on both the deaths and confirmed cases. Sweden, it's actually almost at zero. So Sweden did no lockdown, no masks. Kids always went to school. There's about 6 countries that did the same. They all have the same pattern. They're perfectly fine. Lockdown was a huge disaster that should not have happened. Okay, so same pattern in Sweden. Everything is on the sharp decline. Texas, a sharp decline. A little bit of a pickup in the death count, but this is lagged. But seeing the case count now slowing down rapidly. If we go to Arizona, case count's slowing down rapidly. Death count is slowing down rapidly. If we go to California, case count is slowing down rapidly, as well as the death count. Florida's case count is falling off a cliff. Their death count is still pretty high, although I would again expect that to start to slow down next. As far as the total data, everything's slowing down rapidly. So it does look like we're running out of hosts for this virus to ravage. The weak died first. Now we're affecting most of the stronger part of the population. And that's why we've seen a lot of cases, but not a lot of deaths. The weak died first. We simply changed when a lot of old people were going to die by a few weeks or months. Now, this is interesting. This was way below trend all summer, and it looks like the CDC has come in and revised this higher. So I'm not sure I believe these last few prints here, because for the last months, these were all way below trend. So what happened? Why did they revise that to be so much higher all of a sudden? Okay, if we look at some charts, this is the SPY and the TLT. So what's incredibly attractive about this strategy is to understand that when stocks go down, bonds go up. TLT is in purple, SPY is in the candlestick. And so you can see when we had that great stock crash 2008, bonds went up by about the same percentage that stocks went down. But here's the beautiful part. What happened when stocks rebounded? Did your bond market position get killed? No, it just kept going up. So bonds go up in 2 manners. If the government is expanding its deficit at an accelerating pace, the only way they can pull this off is by driving yields lower. Okay, that's the only way the bond investors make a profit. Otherwise, they're just going to lose. No one's going to loan the US government $3 trillion only to lose 15 to 20% on their investment. Absolutely crazy to think that. They also go up when stocks go down because capital is looking for somewhere to store value. And if stocks are crashing, the alternative are bonds. So bonds are a great part of any portfolio. And until we have yield curve control, they'll be half of ours. Kathy says, what do I think TLT will go to? Oh yeah, I think we're going to blow past 180. If the bond market crashes without a true recovery, the stock market's coming down with it. So I don't think the Fed's going to let the bond market crash, because that would mean we can't raise money and we can't restore the economy. So I think the Fed would just, Ed Portman says TLT or TMF. TMF is 3 times the TLT. So we're just using leverage here. Yeah, so if we didn't use leverage, we would basically underperform the S&P 500. But with the way we're allocated, I'm very comfortable using the leverage we have. So we're taking every 25,000 and making it 58,000 in buying power. Robert says, why the use of the out of the money options? Right, so the correlation of our assets already protects against small moves. What would be detrimental to us would be a catastrophic move in any one of the 4 underlying assets. So I'd rather have 5 puts out of the money to generate a profit in a catastrophic move and not worry so much about small moves, because I'm already protected with the way my assets are combined together currently for small moves. It's really if one of these assets were to fall off a cliff that we could start to see consequences that are highly negative. So leveraged out of the money puts for big drops, and then the portfolio does its job with smaller moves. Okay, so there's your TLT SPY combo. Dollar had a little bit of a bid today. That's the only reason why we're down a little bit today. They're afraid that we're not going to get stimulus. And but think about it. What's going to happen if Nancy and McConnell can't come to some sort of deal? So Democrats want 3.6 trillion or 3.4 trillion, excuse me, $1 trillion to mostly Democratic states that allowed riots and protests to ravage their cities. And the Republicans don't want to give that. Kathy says she likes the new put method better. Yeah, it makes more sense now that we have that balanced portfolio. Before, I was skeptical that we were going to recover because I didn't understand the immune system, and that so many of us were already immune to the COVID-19. So that was a big game changer for us to recognize that we're already at herd immunity, which means now it's just policy in our way for the recovery. Now, the bad news is that the Democrats, unfortunately, are absolutely trying to stonewall the stimulus and to keep their cities locked down. Robert Snyder says, when does the printing party implode? Probably in 2025. It's going to happen when there's too much inflation. Oh, Kathy says she has a trip to New Mexico. I wish your governor would. Yeah, she's the worst. She's the worst. Probably one of the worst governors in the whole country. She has a new rule out that if you're in your car and you're out of town, or you have to wear a mask while you're driving by yourself. She wants everybody outside wearing masks while they exercise. It's just on and on. It's just absolutely insanity. Yeah, so Robert says, when does the printing party implode? It implodes when we get too much inflation. When are we going to get too much inflation? Soon as policy changes, where we open up our schools, we get all these people back in, we remove all these orders where we can't dine together. And more importantly, we have to change the consumer behavior. People are scared to death because of the media. They are scared to leave their house. So how long is it going to take to recover that? I don't think we're going to have a recovery till the end of 2021 in terms of getting close to our economy just of January this year. And it could take longer than that. So right now we're seeing TSA at 25%. So where you check in at the airports, 25% traffic for flights. That's horrible. You go to New York City subway traffic, 25%. Now, lesser large cities are picking up the pace faster, so that's good. But there's so many Democratic governors who are refusing to look at the data and make an action plan to save their cities and their states. So my city is going to be absolutely devastated from this. So again, that bond position is so important right now. Until we really have everybody on the same page and we're actually trying to get this show on the road as a cumulative whole, there's a lot of risks out there. And they may not give up until this vaccine is being forced on everybody. So that's another reason to play Moderna. Once you realize who's in on Moderna, it's Fauci has a patent on it, for heaven's sakes. The guy who's sitting there telling us what we should be doing has a patent on a vaccine that's about to be massively sold to Americans. So huge conflict of interest. Of course, they don't tell us that. Okay, volatility index is important to watch. So when the VIX is low, that makes insurance cheap. So right now, you can buy bonds and insure it for very, very, very low prices. The MOVE index is at the lowest in history. So buying your bond position and insuring it is the best deal out there. The S&P 500 was very expensive to insure when you could have bought the bottom of this crash. And that's why investors were so well rewarded for it. So you can see that insurance cost was extreme. There's no way to even buy insurance in March or April unless you wanted to pay a massive fee for it. As we go to 22 and lower, it's going to become more and more attractive to buy the S&P 500 and to buy insurance to protect against it. So that's going to attract a lot of money into stocks the lower this goes. So that's a good sign for S&P 500. Now, here we go. Here's that little warning sign. We like to look at Ethereum not as a digital currency, a cryptocurrency. I look at it as a technology platform, kind of like Microsoft, but for building decentralized applications. And there's millions of different use cases for it. So Ethereum's really fun to track against the NASDAQ, the QQQ. It gave us a heads up of the crash in March, well before, and then it gave us a heads up of a rally way before the QQ did. So the same big players trading tech are also playing Ethereum. They're going to pull profits off before there's big risks, and they're going to buy the dip when they know there's a recovery. So it's not crashed enough to make me concerned yet. Right now, this is pointing towards a rally in tech and bonds and gold at this point. And our copper gold ratios signaling the same. So this is actually telling me the S&P 500 currently is the most at risk, namely those that are sensitive to interest rates, like the banks. And also think about the banks. How are they going to keep these mortgages afloat if no one's going to pay rent? We haven't fixed that problem at all yet. Here's the S&P 500 against the TLT. And again, we got these both going up. They are in disagreements. Bond market thinks we're headed towards low growth for years, potentially negative growth. And the stock market's claiming that we've overdone it and we're headed to new highs. So which one's right? It's doubtful that both will be, but the Fed, again, knowing that they have to protect both those assets, may force it up by just printing money, which makes our portfolio have better than normal returns. Now, the best protector of your bond position is, again, Freeport-McMoRan or copper. And again, this is just an easy way to play that. So if we did zoom in right here, when the bond market sold off after we had a real recovery in 2009, what happened to the price of Freeport-McMoRan? It went skyrocketing higher. So the best way to protect your bond position is not gold. Gold will actually go down with bonds. It's copper. Most people don't know how simple that is. Here's a look at gold and Freeport-McMoRan in the recovery. So we can see gold did good in yellow, but Freeport-McMoRan did great. And that's because we went from debasing our currency to having inflation. This is another critical set of assets to watch, like a hawk. This is LQD and HYG. These are the proxies to buy corporate debt. So again, these big corporations are borrowing at lower interest rates, and then they're turning around and buying back their own stocks. That makes the earnings per share go up. If there's less shares, but the company's making the same money, well, the value of the share is going to go up. They don't even have to grow their profits and revenues to make the stock price go up if they have access to cheap capital, which they do. In fact, Microsoft last year was pulling negative interest rate bonds out of Europe. Imagine that, getting paid to borrow money to buy back your own stock. So this is very important to watch. Okay, Robert Snyder says, sorry to pester you. Moderna is the hot vaccine stock. I don't trust Fauci or Gates. Do you care? That's why you should invest in it. There you go. You just nailed it. Yes, so they are heavily involved in our boot camp. We go through the origins. So I've studied a lot about the origins of the virus, Fauci's history. So Fauci most likely designed the COVID-19 virus. He was the one in charge of all the gain of function research. We kicked it out of the United States years ago. We have a CDC lab right next to the Wuhan lab. They've been bragging about pretty much every feature that's unique about this novel virus. They've been bragging about the pieces of it over the last decade, about how they've had these breakthroughs and being able to do this and this with the virus. We've got the Wuhan lab being shut down for several weeks in October with satellite imagery. Then we have all of a sudden all of the hospitals getting flooded in October. Then we have the Baidu search terms skyrocketing for diarrhea and cough. Then we have the doctors talking about it in late November, early December, about how there's a new SARS-like disease spreading human to human. And so then, it's very corrupt. But that's why you should buy it. So Moderna's got the smallest market capitalization. They have skipped ahead of 9-figure companies. So 100 just massive, nearly $1 trillion drug companies must be pissed because this little Moderna company who's never made a successful vaccine in history has frontlined to the top before everyone else. They're also getting away with 3 times the price of their vaccine. And the guy who's the spokesperson to tell us what we should be doing is in on it. He has a patent on Moderna. So it's as filthy and criminal as it could possibly get. And that's why you should buy call options on it. They are running the show. But yeah, I wouldn't own it. I would just buy the out of the money calls on that one. Okay, Wells Fargo is a big bank in the US that is critical to the recovery. It's not near the 2008 crash. But if we don't get people paying their rent soon, they have $1 trillion real estate book at risk. That is systematic risk to the whole economy. So we need to see Wells Fargo recover here. If this starts to dip much lower, watch me get quite concerned about the S&P 500 position and protect that better with puts. That would also be very good for our bond position if this crashed. And again, this is a canary in the coal mine. Now, at some point, I would love to buy beat up banks instead of just being long the S&P 500 or perhaps some call options. But I think it's just too early to make that call. Until the Democrats want to open up their states, we're going to have more people not paying their rent, just as simple as that. And we're going to have more job loss. We're going to have more businesses going out of business. We really haven't felt the pain of what this has done to our economy yet, because we've just been printing our little hearts out, hoping we can at least get things in decent order for a recovery. Okay, another bank you got to keep your eyes on are HSBC Bank out of London. This is trading at 2008 levels. They have huge exposure, massive exposure to Hong Kong, the most expensive real estate in the planet. Think of Japan in the early 80s when their real estate stock market crashed. Same setup, same mistakes that Tokyo made are being made in Hong Kong today. And I do think that Hong Kong is going to crash. That's why we're shorting its currency in the boot camp. So that's every Thursday. Super easy trade to put on with TD Ameritrade. So a lot of news out about China. Not only are we going to delist their securities potentially, not only did we put a ban on Carrie Lam, the president of Hong Kong, not only are we cutting TikTok's legs off in WeChat, they're getting aggressive right now. So that's good news for our bearish positioning, at least. Not good news for a time of peace. Okay, Deutsche Bank is the third large bank you got to keep an eye on. They have what's rumored to be $100 trillion derivatives book. They're taking a loan product, then they're making an interest rate insurance product from a loan product, then they're creating a derivative from the insurance play, and they're repackaging, reselling it. It's absolute insanity. They've been trying to deleverage this for the last decade. But you can see Europe's had negative rates for the last decade, and it's destroyed Deutsche Bank. Banks need positive yields to thrive. So not good to have interest rates so low for your banking sector. Now, if this goes below 7, a lot of people have said that is crisis. We did go below that during the March. I bet you a lot of the money that we had to print went to this bank to keep it solvent because it is a systematic risk to the whole financial system. Okay, now if we look at emerging markets, one could argue that we never recovered from the 2018 crash. World stocks hit a top in 2018. It's really only the NASDAQ and for a short minute, the S&P 500 that we had new highs in 2020. The rest of the equity world is not recovered. And so we very well could be going into a second wave down in equities when we look at the big world picture. Same is true for the other major market, which is the European stock index. Same exact pattern, except emerging markets looks quite a bit stronger than Europe. So again, if you don't have half your cash in bonds and you don't have some precious metals, expecting governments to, what's the choice? Governments either give up and let everything crumble to the ground, or they do what they always do. They print money and they go give it to people who they think are in trouble, hoping it'll solve the problem. So they haven't given up yet. I don't think they're all going to quit. You got to look at how much do these Federal Reserve people get paid? They're collecting something like $1 billion a year at the US, getting salaries in the $500,000 to $1 million range. We have thousands of these guys. So it's either they quit and say they failed or they print some more money. That's really the only option they have. Here is gold reacting to, again, expectations of inflation. We don't have it yet, but more importantly, bond yields getting unattractive, going so low. So gold is important in your portfolio right now. Silver is just a more aggressive gold play. I prefer to have that in either small quantity, which we have in our buy and hold, or with call options, which we have for pro members who also take the boot camp trades. Here's that gold to silver ratio. And again, note that at one point in the printing spree of 2010 and 11, silver overtook gold by many magnitudes, by like 600%. So it looks like it's on the verge of taking over a better return than gold also. Although I think we should see gold go much higher. Probably it could go all the way up to 5,000, I'm thinking, in the next several years. Before I'd be too scared of the price of gold and get more aggressive in copper. Over time, you will see I'm going to be taking some cash out of gold and getting more aggressive in copper. And that's going to be completely dependent on seeing the right policy action and a rebound in travel, really. We need to see the travel pick up for energy too. I think watching travel grow will be the single best indicator of a recovery. Oil's the same picture. We're seeing this stall out here. That's not good. We really need the price of oil to come back up to a profitable price. At 44 a barrel, everybody's going to go bankrupt. We really need it trading above 60. Once we're above 60, then all these energy companies are actually going to have a good profit. But at 44, this is a nightmare. And also telling us recovery is stalling out. Good for bonds, good for gold, bad for stocks.
Hey, Jason, a couple of questions came through here and just wanted to direct your attention to them.
Great.
So, yeah, absolutely, bud. So let me see here. Let me scroll up. So Kathy C asked if we, do you have a site that shows others that Dr. Fauci has a patent? So that was one question from Kathy C out in Dallas. And then let's see here. We have Ed Portman with his hand up, Paul Scott with his hand up, and Robert Snyder with their hands up as well.
Sure. Yeah, we can do a question break. Let's do it.
Nice. Very nice, bud.
Let's do Paul Scott first.
All right, Paul. And
ooh, look at those vaccines. That is scary. Yeah, so NIH claims ownership of Moderna's coronavirus vaccine. And then who controls the NIH? Fauci. Okay, so yeah, let's see who we have. Paul, you need to unmute your mic and you can ask questions.
And Paul, if it's your first time using Zoom, bud, if you scroll down to the very bottom of the screen with either your mouse or with your tablet or phone, what's going to happen is a gray bar will pop up at the very bottom. And on the bottom left-hand corner, there's a little icon that looks like a microphone. You can actually tap on that. That will unmute your microphone. And then you can ask any question you have live here, bud. And Robert Snyder, same thing for you, bud, if you want to go ahead and get your microphones set up there.
Yeah, Nav, we can talk about your portfolio build out right now too. And of course, we're always happy to help you out on the phone too. But yeah, what questions? Let's get Nav's microphone unmuted as well. He's a new member. So let's ask away, guys. I'm here to help you. So please. Also, we have much better experience for everyone when there's a lot of questions.
Yep, absolutely. The more questions you ask, guys, the better interactions you're going to be, and the more value you're going to receive from us. So Paul Scott, we're ready when you are, and Robert Snyder, we're ready when you are. Also, Nav, if you want to go ahead and just unmute your microphone to kind of see how much capital you're looking to allocate, we'll walk you through that too. Hey, Nav,
Okay.
how's it going?
Good. How are you?
Good, man. Very good. Thank you.
Yeah, I gotta go through those videos that you guys sent. I just didn't get chance, but I know yesterday you were talking about, how many shares to buy because the numbers in the list was different than buying actual numbers.
Yeah, let's
So
go
that's why
through
I'm a
it.
little confused.
Yeah, let's go through it. No problem. Let me pull up the trade alert.
I just don't want to make any mistake.
No, you know what?
No,
We've got
absolutely.
millionaires calling me to confirm it. And maybe you're a millionaire too, but yeah, it's common to just, when you're putting a lot of money on the line, you want to make absolutely sure that you have the right allocation of capital. So that's totally
Right.
understandable. Let me grab the link to the trade alert and I'll pull it up.
It's in the chat box, Chase.
Yeah, link didn't work for me. Let me try again. Oh, there we go. Okay, so how much capital are you trying to put to work today, Nav, so we can do this together?
Let's say 50K plus.
Okay, so if we're doing 50K, we're gonna do, and then maybe take some notes. If I were doing $50,000, what I'd do is I'd buy 400 shares of TMF,
Okay.
200 shares of UPRO,
200 U Pro. Okay.
200 shares of UGL,
Okay.
400 shares of Freeport McMoran or FCX.
FCX. Okay.
Okay, and that's the tank. Okay, it's critical you do those at the same time. We don't want to look at charts and be like, oh, that looks like a bull flag or a candle or an elephant or a giraffe.
Right.
Okay, throw that out the window. Okay,
Okay.
market goes up and down with buying and selling pressure.
Right.
Patterns in the sand are not important to us. Okay, what's important is we have the right risk management. So buy them all at once. Step one,
Okay.
done. Step two, now we're going to build your force field. The force field has no value against small moves. It has tremendous value against catastrophic moves. So because you're doing two lots, you would buy 20 821 TLT 163 puts.
20 of those TLT. Okay.
Yep, 821 163.
Right. Okay.
You're going to buy 10 821 SPY 290 puts.
Okay.
10 821 175 GLD puts.
Okay.
20 FCX 821 $12 FCX puts.
Okay. And all these puts. Okay.
And then did you get the boot camp trades yesterday?
Yeah. Not everything, but I entered those two SPY and then I think TLT.
Okay, so the boot camp trades yesterday were Ryan, could you post me that link? I'll put it up for everybody today. It's fine. But just know if you do want to get into boot camp, that's typically a Thursday presentation. Let me pull up the boot camp trades just so we make sure you're 100% set to jet here.
Okay.
And I'm sure there's a lot of, in fact, one of our new members, Frank, called me up and we walked him through the same question. So people just want to be 100% confident. Okay, so here was yesterday's boot camp trade alert. Okay, per 25,000, so double it. So you'd buy two August 21st, $80 strike Moderna call options.
Oh, sorry. Yes, that's right. That I remember now. Okay, I did that.
And then 20
Nice.
of the August 21st. Now we're going to be rapid firing these. So with out of the money call options with short duration, realize I don't care if I lose 100% a couple times on this, because I know that we have very good things happening in the next 6 months. Number one, we have phase 3 coming out. We probably have forced vaccinations, and we know these guys are going to pump this stock. So I'm willing to put this bet out and close it like rapid fire every Thursday. So expect us to close this out, pull any profits or losses out of the position, extend the date by a week. And we're going to be doing this until silver's above 50, until Moderna's above 120. And then we'll probably stop and consider moving into some different investments like playing copper and perhaps uranium and other commodities next with a recovery. So I would say we'll probably be playing these for the next 3 to 6 months like this on a rapid fire basis, going for anywhere from 100 to a 500% return on the wins. But realize we could have some losses on these. This is aggressive, small position that we're going to roll out weekly. And we've been doing really well with these. So we've had 2 plays on silver that were over 100%. I should have not. We were just so hot. We were winning so much last Thursday. I decided to take a step back from silver. We should have kept with the play, but we're back into it. I do want to play the silver melt up. That's you only get that once a decade when the Fed's lost control of the economy and they're printing like a madman. So you don't want to miss out on a once a decade play. Okay, so that's good.
Okay, so, sorry, two mRNA and then 20 of the SLB, right?
Yep, and then you
Okay.
should also follow this tutorial to short the Hong Kong peg. This is the trade that can deliver a 100-to-1 return if it goes from a value of 13 cents to the dollar down to a penny. And once we look at the news today, I think you'll be pretty excited about this trade. Now, this trade, virtually impossible to lose because of the way the peg's designed, and it's trading on the strong end of its band. So the risk reward on this is phenomenal, but you must be patient because it will take a catastrophic move for this to play out. Okay, good.
And I'll follow that link how it's done. I don't think I have shown before. Oh, it's just buy to open like a call?
No, you're going to have to follow these tutorial to the T.
Okay.
I'll have
Okay,
Ryan
will.
send you that link so you can go through it.
Hey, and then I'm actually sending it to you right now, Nev. But yeah, it's a pretty intensive process, but literally Jason will walk you through it step by step.
Every
Great.
Thursday we cover how to do that, but it's easy. It's really not that hard. 2 clicks once you get, so you got to get approved for Forex. You got to transfer $1,100 into your Forex account, and then it's 3 clicks total. Type in Hong Kong dollar. Well, you can follow the tutorial. It is very, very easy once you get set up to do it. And you can call it in too. A lot of our boot campers just call in the order, buy to open USD against Hong Kong, Forex trade with 1 mini. Boom, you're done.
Okay.
Yeah, a lot of people just called it in.
Well, that'll be easy. Yeah.
Yeah. What other questions we got out there, guys?
Okay, cool. And then Nev, did that make sense to you on how to build out everything for the portfolio for the to get everything built out as far as the tank and the force field around it?
Yes. Yeah.
Okay, cool. Yeah, and every time we produce a trade alert, Nev, literally all you have to do is just mimic that step by step in your account. It's super simple.
Okay.
Okay, awesome,
All right.
buddy.
Thanks.
Absolutely.
Let's see, Gary's got a question. You going to be part of that 250,000 motorcycle gang rolling around? I think that's, what is that, coming up in a week or two, Gary?
Let's see here. And then we have Paul Scott and Robert Snyder too. Just when you guys are ready, go ahead and unmute your microphone and we'll go ahead and walk you through that.
Let's see. Raj is asking about learning options. Ryan, do we have a easy? Send me the link to the 5 modules of the boot camp so I can at least show Raj what we have for him. I've had people who are professional option traders tell me that my option course taught them things they've never learned before. And what I want to point out is, if you look at our product, does this seem like an overly complex, sophisticated, crazy system where you got to do a lot of work? No. We would rather create the beautiful painting with as few strokes as possible. Gary's trying to get his microphone unmuted. We're not trying to make you chase your tail in this product. We're not trying to make you jump through hoops. Don't you hate it when the math teacher makes you do the problem like a long, hard way when you know there's a very easy way to solve the same problem? So that's the goal of this. We don't need to make this complex and hard to follow. So let me just show you guys what's in the boot camp. Ryan, do you have that link, Candy? For the 5 modules. 2 of them are about how to trade options that will teach you perhaps more in a couple hours than some people have learned with huge $10,000 option trading programs. Gary, go ahead.
Well, to answer your question about the 250,000 motorcycles, I've done that a couple of times. Not this year, but
that looks fun, huh?
Oh, listen, everybody, it makes Mardi Gras look like a Sunday school picnic. I'm not kidding you. I've never seen anything. The old saying in Texas is like, I've been to 3 rodeos and 2 goat ropings, and I've never seen anything like that. It's just crazy, crazy people. But yeah, that's what we're shooting for. A friend of mine is never the guy from here that's going to go with me. He confirmed it last night. We went out last night and belted down a couple of beers and talked about it, and I got him to confirm that, you know, if we do go, he's going to go with me. He's already talked to his wife, got a clearance there. We're planning on about 6 weeks. You know,
oh, it's going to be so fun.
Yeah, I've done it a few times, man, and it's just nothing like it, especially out west. Well, you know, you're out west. It's nothing like it.
Beautiful riding.
I've tried, I guess, a half a dozen times to get up to the Finger Lakes in New York, and it just can't do it. I mean, even in the summer, it's hot. I mean, it's cold. And I don't mind the rain on the motorcycle, but when cold is just miserable.
Yeah, you can't be wet.
We've tried it 2 or 3 times, and a friend of mine come up from Texas, and the one that's going to go with me this time, I hope. Well, he will. He's already said it too. I just wanted to listen. I'm not. I hate to bug you about this, and if you've already, I just don't know if you have sent that colloidal silver, because if you have.
No, I gotta get it shipped.
Okay.
I gotta get this all packaged up. There's about 5 of you I gotta ship to, so
Okay.
I gotta get to it. That's my bad.
Well, what made me think of it is you had some mail misdelivered, and I said, "Oh my Lord, what if he'd already sent it and I didn't get it? I hadn't thanked you or anything." So I said,
"No, it's my fault. I'll get that out tomorrow for sure."
So don't hurry. I just wanted to make sure I hadn't overlooked it.
Yeah, no, it's my fault. For everybody listening, I had a bunch of extra colloidal silver, and I offered to ship it to a few of our members, but it's all accounted for now. So nobody else, please send me your address. We did. We got inundated with a bunch of folks who wanted that. So no, my pleasure to ship that out to you, Gary.
All right, thanks a lot.
Yep. See, would anybody else like to ask a question?
Nice, Gary, and have fun riding, bud. And keep us updated when you're coming to Albuquerque.
Okay, let me go ahead and continue with the news, and then we can wrap today up and send everybody off for a great weekend. Oh, Joseph, please. Let's see, Joseph, I think you'll have to unmute your mic.
Okay, can you hear me now?
Yes, sir.
Okay, sorry. Yeah, so I have a team member who was asking me a question. I think she's on this webinar. She told me she was, but she wanted an answer. She said, yesterday we were up 140,000 at some point on our simulated portfolios. And, today it's gone down to 115. So she was just asking, why didn't they take profits yesterday? And I thought, I told her, she should come on the webinar. I think she came on the webinar, but that's the question. So
Yeah. So we're always invested. The bottom line is if you try to guess the market, you're going to miss out on the big gains. So yeah, we're never not invested, period, for any reason. So we like to basically get the big picture right and stay invested and manage risk with asset allocation as well as put options. So yeah, if we were a wimpy little day trader, there's no way on God's green earth we would have had a total return of 15% on every penny in our portfolio in 90 days. Not possible. Why? Most of the gains happen overnight, not even during the day. So yeah, we will remain fully invested until the end of time and manage risks with put options. And the bottom line is you don't want to own cash in the long run when you're devaluing your currency because you're in an economic crisis. So there could be a time where cash is an investment we want to hold. Namely, that would be when interest rates are being driven higher. So that's probably 3 to 5 years out. So again, if you do go to cash too often, you're going to miss out on the big moves, one. And then two, your buying power is going to be eroded quite quickly because the government is spending a whole lot more money than it has at the fastest pace in history. Very good question. I was joking yesterday that we could sell yesterday and call it a month. But that's not the way smart investors play the markets.
Yeah, and to kind of to their points, you guys, obviously, we're looking for a lot more in this portfolio setup. So if you're not allocated, we did have a little bit of dip in gold today and in bonds, okay, and in stocks, which is rare. Like it's so rare to get all three assets class to kind of taper off at once, right? But that's a beautiful entry point for you guys to allocate new money. Okay. So yeah, Joe, I would definitely tell, it's probably Anita, I think you're talking to, right?
yeah, yes. Mhm.
Okay. Yeah. I would definitely tell Anita, hey, that's a great opportunity for her to put that money to work. Okay. But yeah, we're looking for a lot more upside, Anita. and that's why we didn't sell. If you see us sell, that's when you see us changing our scope, our lens, our roadmap for what we're doing. And what
the other thing I want to point out is when central banks are printing money, this is a rare opportunity that happens about once a decade. And the bottom line is your purchasing power is going to erode quickly. So you have to invest. You have no choice. If they're going to go print trillions of dollars, think about it. We took the Fed's balance sheet from $3.5 trillion to $7 trillion in 3 months. So your buying power, as that money leaks into the system, is going to drive the price of goods up and erode your buying power. So this is the time where if you don't invest, you're going to miss out on the best returns in the market, one, but two, you're going to see a negative return on your buying power. So if you stay in cash during a period where there is economic turmoil and the strategy the government takes to try to fix it is printing money, then it's a dangerous time to be in cash. So I would actually say, who cares if we have volatility of 3%, especially when we're up as much as 18% in the last 90 days. When you look at the potential risk, what if your buying power erodes 50% in the next decade? Yeah, that's not good. All right, let's look at the news. This will also give us some insights to why did the dollar go up a titty bit and pull us back slightly on our positioning? Because there's mixed data. So these markets are all looking at different data points. And so let's try to look at the big picture and put it all together now. Okay, Gordon Chang. China has just told Tokyo it might send hundreds of vessels into Japanese waters this month. That's an attempt to both break apart Japan by prying away the Senkaku Islands and bust up America's century-old Western defense perimeter. So what's China up to? They've been building out the South China Sea, which they told Obama they would not do They've put extreme military capacity all throughout the entire region. We don't have a chance to get through there with fighter jets or naval. So it's almost silly that we have our boats trying to aggravate them in there. Now they're trying to push moves on Taiwan. They just took over Hong Kong and broke their agreement with the British. And now it looks like they're also trying to push towards taking over Taiwan. They're trying to take over territory that Japan claims. So this is getting more aggressive by the day. It looks like to me, so one of the founders of Facebook's a fellow named Peter Thiel, who is a conservative. He's actually, I believe, a gay conservative, which is interesting. But anyways, the point of this is not that he's gay, but the point is that it looks like Facebook has been trying to be pro-Trump in a world where the technocracy, the huge technology companies really don't like his policy whatsoever. So we're talking about Microsoft, Apple, Google, all these big tech companies, as well as all the big manufacturers who create anything in China, which is just about everything. None of them want us to go after China because that's where they get cheap labor. Also, they're starting to build out AI with China, who has the most data. They're looking at China as the biggest market and potentially the greatest economy within the next 5 to 10 years. So what has been going on? Well, interesting enough, Facebook has benefited from policy that we just saw Trump roll out, which was to ban TikTok, the only competing app in the world that stands in Facebook's monopoly in terms of social media phone apps. So Snapchat is a little guy. TikTok was growing rapidly, and Trump just banned TikTok. Now Microsoft's trying to purchase it. We're seeing Microsoft and a lot of these other groups who are pushing for keeping the global order how it is, not trying to basically make China act as a more of a capitalist society that integrates well with Western law, which they absolutely ignore. They're completely breaking all of our laws, and they don't care because they know we all rely on them for our supply chains. So anyways, Facebook benefited massively from TikTok potentially getting its legs cut off here with the action from Trump. A good political stunt, great way to show he's tough on China. It looks like Facebook may be helping Trump here, despite those Project Veritas videos coming out where all the moderators are obviously censoring content that's a certain type. Anything that is pro-Trump is being censored. So it's interesting. And Peter Thiel is a conservative and a huge investor in Facebook. So interesting development there in terms of the US-China relationship. US sanctions Hong Kong chief executive and Beijing puppet Carrie Lam. Okay, so it's more of just a headline. She just does whatever she's told to do. The next big thing that Trump did, and he has a headline that he told some folks in Ohio yesterday, you may not see me for a while, but he's created, well, here it is. Trump blamed the American political class for the fact that drugs are cheaper to buy in other countries like Canada, even if they're made by the same company. So I have a lot of enemies out there. This may be the last time you'll see me for a while. A lot of very, very rich enemies, but they are not happy with what I'm doing, said Trump. But I figure we have one chance to do it, and no other president is going to do what I do. No other president would do a favored nations, a rebate, a buy from other nations at much less cost. So what he's talking about is allowing pharmacies to go around the brokers and get drug prices at extremely lower prices. So this is very aggravating to the pharmaceutical industry, who do seem to be partnered with and own most of the media, as well as partnered with the tech companies. So he's absolutely right. He has a lot of enemies. All of the most powerful companies in the world essentially do not like Trump's policy whatsoever. Which is why I think we have some potential chaos going into this election if we haven't seen enough yet. Okay, so again, we have a deadlock with McConnell and Pelosi trying to get any stimulus. I don't know the legal system well enough, but now Trump's trying to create executive orders to create a payroll tax holiday and potentially even create a stimulus payout. So we'll see if that is able to occur. If not, I think stocks will get quite upset if we don't get a stimulus very soon here, because that unemployment insurance is over now. People have no jobs. Governors are not reopening their economy. We're really in quite a mess. Now, Charlie McElligott for the last month has been warning that as soon as September, there's a risk of the treasuries selling off, which would be bad for gold and tech stocks, as they're both benefiting from low yields on bonds. So we have our eyes open for that. But when I look at the geopolitical tensions between US and China, when I look at the civil war developing between the Republicans and the Democrats, I think there's enough fear and potential chaos to safely hold our bonds through September. What I'll do, and again, August is supposed to be the best month seasonality for bonds. Then in September, all the corporations come back from their break and start doing massive debt issuance for corporate debt. That's one of the catalysts he's looking at. I'll probably just increase the insurance in September to be better protective of bonds so that we can still have half our portfolio, because I'm not buying it. I think we're going to have chaos all the way into the election when we look at some of these recent moves. Now, I was wondering if Trump was just going to play it easy all the way to the election, but clearly he's not. He's going after the pharmaceuticals. He's going after China with TikTok. And now we're having a deadlock for stimulus. So this all equates to bonds going far higher and stocks having potential sell-off if these don't get resolved. And it doesn't look like they will. Okay, Secretary Pompeo, today the US is designating 11 individuals responsible for the erosion of Hong Kong's autonomy. We will not stand by while people of Hong Kong suffer brutal oppression at the hands of the Chinese Communist Party or its enablers. So again, they're going out with these headline sort of sanctions that really don't impact finances yet. For Hong Kong trade to play off, it has to be a financial hit to Hong Kong or China. Okay, here we can look at the new COVID cases by region with a daily growth chart. So you can see it's coming back down. It's really just all these states that have stayed locked down that are going to have the cases. I don't think you'll see another big spike in Arizona, Florida, or Texas. So that will be, or New York for that matter. So while everybody stays locked in, we'll see these states opening back up with no problems, and everybody's gonna be scratching their head. Steadily, a new set of morales have taken over Hollywood, one in which appeasing Chinese government investors and gatekeepers has simply become a way of doing business. So China is now censoring the whole world, because if you want to be able to sell your products in China, you have to abide by their rule book. So the South Park episodes last year were hilarious about this. Hopefully they have a new episode season coming out soon. Okay, executive order for essential medicines will be signed today. Again, this will piss off the pharmaceutical companies, who are the main ad buyer for most media. And most of the media is controlled by the same people who own the pharmaceuticals and the tech companies anyways. So expect a lot of heat towards Trump for that move. Tim Pool, nationwide riots, defunded police, DAs releasing rioters in numerous jurisdictions, people being attacked and even shot in their cars, has really changed my stance on gun rights. 7 months ago, I said absolutely no guns in my house. After the riots, I bought several. I believe one of the biggest failures of this pandemic was not getting schools back open. We're told September, but I read worrying stories about that. I really don't want to hear any excuses in a few weeks. They've had plenty of time to prepare for it now. It has to happen. Think about all these teachers, walking around with corpses, fake corpses, saying, you're going to kill us all. What about all the doctors and nurses who just did their job? Didn't hear them bitching as much as the teachers. White House economic advisor Larry Kudlow says he was working last night on the executive order to offer payroll tax relief. Kudlow says the draft of the order is completed if the president wants to use it. So I like that, because now you're benefiting people who work, not people who want to sit there and get a free, want to be a freeloader. But I'll also say that's not enough because of our policies. Many people just don't have a job, even if they wanted one. So we need both stimuluses right now. Otherwise, we're going to have a huge problem on our hands. Now, this is important. So this is abnormal low traffic congestion. The blue line is, well, all of these lines, we want to come back up to 100. So we can see originally we crashed really low in March, and we're making a recovery into June. But in July, we've been pulling back more restrictions because of seeing more waves. So hopefully this will start to go back up. And this is kind of like that gold copper ratio for us. If it's pointing down, that's good for bonds. If it's pointing up, that's good for stocks and copper. They're holding up the spending package over state bailouts. None of the stuff they mentioned. So again, the Democrats want $1 trillion for the Democratic states that allowed all the rioting to ravage their cities and who refuse to open their economy. So you can see why we're stuck. And we may be stuck until we get a crisis. If there is no big stimulus package, gold tanking will be one move that takes most by surprise. The entire rally has been driven by an expectation of stimulus, inflationary, and zero rates for years. If DC takes their foot off the gas, the Fed is left pushing on a string. Maybe, but if the bond yield is going down at such a fast pace, and we expect that they will eventually do their job, which is to print money and spend, then I'm not too sure that a standoff and stimulus is going to hurt gold that much right now. So we'll see. But again, we have puts protecting that. As long as the bond market's traveling higher, I'm not going to be concerned about gold. And as long as they're not doing a stimulus package, I'm going to bet bonds go up and stocks go down, as well as gold. So I think he's wrong on that one. Ray Dalio warns a capital war between the US and China would hit the dollar. So he's on Fox News now. He's got a whole army of people trying to stop this US-China crash and decoupling. Why? He's got at least $40 billion of his assets under management from China. So he's highly motivated to be pro-China. Russia-China de-dollarization. So this is interesting. They have now started trading between the ruble and the yuan. So they've given up on using the dollar, which means they have to now start paying close attention to the value of their currencies if they're going to do significant trade. And neither of those currencies are highly traded. So this is an interesting move, but one in which we've seen coming for quite some time. These big powers don't want us to have this sovereign currency. Gives us a huge advantage. Freddie Mac warns apartment loan supply may plunge as virus crushes working poor. So again, this is the big picture. No one's paying their rent. There's no jobs. There's no jobs because governors won't open up their states. COVID-19 ended in Europe 7 weeks ago. There have not been more excess deaths. Why isn't life back to normal in Europe? Well, the only explanation is fear and politics. That's absolutely right. We got to get through the consumer shift of being so fearful. We got to get through these politics, which are being used to as a political weapon, not for the good of the people. Tencent has US video game affiliations, not included in offer, which is good for me. I play a couple of games that Tencent bought out, or my kid does, Fortnite, and then I play Clash Royale. But amazing. Imagine one day you wake up and the two most popular phone app games in the world are gone. It very well likely could happen. if things don't change soon. Okay, so we'll end here. Trump advisor urged delisting of US listed Chinese companies that fail to meet audit standards. Goodbye, all Chicoms. So we've been predicting this could happen since last year, and it looks like we're headed towards that way. So I haven't put out the put options on the Chinese stock exchange yet. We have a trade review on the 15th. So I'm betting that basically this is all posturing to try to get some major purchases out of the Chinese for the phase one trade deal on the 15th, which is where we're meeting them to go over how they failed to do pretty much anything they promised last December in the phase one trade deal. So is all of this just posturing to pressure China to start buying some agricultural and energy products? I think they would. I think they would drop all of this if they started making some massive purchases. But will the Chinese do it? Maybe not. Maybe not. Okay, very good. That is the okay. Frank's asking if we should add a little more to his silver call option. You could add 2 more if you want, Frank. I don't think that's a terrible idea. Robert Snyder says, great presentation. Loved it. Oh, thanks. Really appreciate that. Robert says, how long may the gold decline last? I personally don't buy it. I don't think it's going to go below 2,000 here. Unless, so here's what, if I don't think that a bot, so let's go back to that tweet. Let's talk about what, and this guy is really smart. I admire him. And he used to work for Ray Dalio, funny enough. So he's saying that, look, if we can't keep printing money and creating inflationary fears, then what's going to happen? Well, he's saying that gold would sell off, but I'll tell you what's going to happen. If we don't create stimulus, what's the first thing that's going to happen? Stock market's going to sell off, not bonds. So bonds are going to go to an even lower yield. So I think gold may trade flat if this happens, because sure, we're not getting the inflationary impulse from stimulus, but we've driven the real yield more negative because stocks are going down and driving yields lower. So I'm not sure that gold will tank. I think it'd be the opposite. I think a recovery would actually tank gold. So if we had a recovery and money all of a sudden realized, hey, we have bought way too many treasuries at way too low of a yield, there's a recovery in sight, we're 3 months away from all this bullshit completely evaporating, then what would happen? Well, money's going to just pour into energy, communications, airliners. Everything that's beat up is going to get a huge bid. Bonds are going to get dumped. Tech stocks are going to take profits. Gold and Bitcoin are going to crash. I'd actually say the opposite is true. It would be a real recovery. A bond market crash will take down tech and gold. I don't think anything else will, because we can see through it. Yeah, they might fight for a little while, but once the S&P 500 sells off 15 to 30%, you better believe it, they will come out with a stimulus package and probably yield curve control. So that's my 2 cents on that. And it's a good insight. It's a good insight. But I think the bigger fear would be a recovery would be bad for gold, because people would start getting out of this overextended bond position and load up on banks, everything that would benefit from a steepening yield curve, which would be energy, banks, and it would be detrimental to tech and treasuries. Yeah, you're welcome, Frank. Smart question. Okay, very good. Well, unless there's any other questions, we'll send the baton back to Dean to close this out and finish this race. Oh, you're welcome, Victor.
All right, Jason, thank you, bud. Appreciate that. All right, folks, and give me 1 second to set up my screens and we'll go ahead and close out here. So thank you, team, for joining us here today. I truly appreciate your time and attention. All right, guys. So any last minute questions before we go to the closeout here? Just want to make sure everyone has all the questions that they have answered that they were looking to get addressed. And folks, just want you to know that we really do take pride in answering all the questions you do have. We want to definitely educate you as much as we can. Hey, Karen, how's it going? And Jason, I was just on a call, but I heard Frank was on. So that was cool. What was Frank's question? Okay, I think we may have lost Jason there. I think he may have stepped away. All right, guys. Any last questions? Let's see here. And okay, I don't think we have any more questions. So Karen, how's it going? I haven't seen you live on here in a minute, so I figured I'd say hello. If you want to go ahead and unmute your microphone, please feel free to do so. And Frank, hey bud, if you can, we'd love for you to unmute your microphone too, Frank. And Frank had an awesome analogy about getting into the tank that I thought it was pretty funny. So I figured I'd share it with the crowd. Let's see here, Ryan, if we can unmute Frank's microphone, let's have Frank talk about his analogy about getting into the tank. It was pretty funny. Hey,
Can
Frank.
you hear me?
Yeah, how's it going?
Hey, good, Dean. How are you doing?
Great, bud.
Yeah, so anybody that's listening, I don't even know how many people are on the call or not. Just a real quick background, like another member who said something the other day, I was a part of a couple other investor groups and had subscribed to Stansberry as well. I still subscribe to Raging Bull, but it's not an investor plan like what Jason and Dean are offering here. It's more just, it's almost like buying a lottery ticket, which is just way too risky, right?
Yeah.
So first I got to say that, after sort of following you guys since the beginning of the pandemic in March and having jumped into a couple other programs, because clearly there's an opportunity, to leverage what's happening in the market, even though there's a lot of bad things happening. When you approach it in an unemotional manner, the way you guys do and the way Jason breaks it down, I mean, to me, it's just absolutely phenomenal. And so the tank thing, I can really wrap my mind around because, who doesn't want to be, driving in a tank with your, life savings in there with all that protection. And I guess when we were talking, Dean, I think I just was like, I was listening to some callers that were a little hesitant, and I've got a pretty significant amount of money invested. I'm not going to say how much, but it's more than six figures, put it that way. And, so to step up and pull the trigger and make the investment and have the faith in you guys, it took a lot, especially with, the background that I shared with you earlier, Dean, and maybe another time we'll talk about it. But
Sure.
At any rate, the analogy was, for those that are sitting on the sidelines and hesitant on, putting at least the 25K in there or even the 1,000 or whatever you might have to just get your foot in the water, it's kind of like, all right, the tank analogy is awesome. And the bottom line is if you can climb into the tank, which anybody can climb into a tank, right? Which is the same as, anybody can make these orders. I mean, they've laid it out and they lay it out every time. And I've just actually put some more money in and, taking advantage of the down market right now. I'm not trying to time it by any stretch, but, I picked up some more tranches today, just now as we're talking, and with, 100% confidence. And I've only been doing this for about a week. And so, if you can climb a ladder, get in the tank, the only thing you got to really do is watch out so you don't bump your head, right? but other than that, you guys have built a very, in my opinion, safe and sound investment strategy. And, I knew about Ray Dalio, and, so to follow, a plan that he's been implementing where he's investing billions and billions and billions of dollars. I mean, we're all small potatoes compared to that. So if this strategy is good enough for Ray Dalio, it's absolutely good enough for me. And, I just can't thank, Jason and Dean enough, for what you guys are doing. I mean, the teaching, the training, I mean, I've just never felt more confident in what I'm doing in the market in my whole life than, with what I'm doing with you guys. So thanks.
Awesome, Frank. Hey, bud, thank you so much. And Frank, we didn't pay you to say that, right?
No,
Just-
absolutely not. It'll tell another time. I'll tell you guys a little bit about my background and why I've been a hesitant investor. It'll take a little time, and I don't want to take up everybody's time because there's probably other people with some questions. But I can just say that, if you're sitting there and you're worried or you're concerned about getting in, I can say this: I've already made back my $5,000 investment. In the program in just a week. Now you have to have some capital, obviously, to do it that quickly. On $1,000 investment, that's not going to happen. But if you've got some money to invest and it's just sitting there, I think as Ray Dalio says, cash is trash, and you're losing money if your money sitting in a money market or a CD or in the bank or just somewhere sitting there kind of rotting away with the inflation. So at any rate, not a paid spokesperson, just a very happy customer.
Awesome, Frank. Hey, bud, appreciate that. Because we
Sure,
always
you're
get
welcome.
people to ask us if we paid people to just talk about our service. So I always think that's funny. But thank you so much, Frank. That was awesome, bud. And
No, you're welcome. Thank you guys.
Absolutely. Cool, Frank. And good on you for recognizing, right, a good entry point today. So that was really cool.
Thank you.
Awesome. Learning quick, Frank.
Well, from the best. So appreciate it.
Okay, cool. Well, Frank, have a great weekend and appreciate that, Frank. All right, guys. Any other questions here? I think we might have to put Frank on this board here after that awesome review. Anyone else out there, folks? Let's see here. Robert Snyder. Let's see here. Do you have any questions, bud? Let's see here. Yeah, and so Robert Snyder said there will be no recovery until long after the election because the fear is being driven by the powers that be. Yeah, so Robert, one thing I would say that would caveat that, bud, is you have a coordinated effort from central banks around the world to push markets higher to create jobs. Okay, and look back in 2008 for your example of that. Okay, 2009, they were absolutely able to do it. And so, a lot of people think things are, really contingent on the election. And I agree, there's a lot that is. But guess what, guys? The central banks, all the G7 central banks right now are printing it. Okay. Global coordination, printing markets up.
And we'll do better even if there isn't a recovery anyway. So
Yeah, exactly. That's the other great point there, Jason. Yeah, if the market tanks, guess what, guys? We we grow our capital actually faster.
we're
Which is
very
pretty cool.
pro America here, but we just also have to realize the risks. Absolutely.
Cool. And awesome commentary there, Robert. Definitely, bud. And Robert, give me a call after we get off the presentation here. I'd love to continue the conversation. All right, guys. Any other questions out there at all? Okay. And folks, if you are in a trial, if you have any questions at all, just feel free to jump in. Okay. So, and with that, Jason, I think we pretty much covered it today. So folks, if you don't have my number saved in your phone yet, actually, let me go to this slide. Go ahead and put it in your phone. Okay. It's 505-322-7515. Okay. If you guys do have any questions, you're on a trial, you want to get those addressed before you get started, give me a call. I would love to help you with your questions. I'd love to walk you through my portfolio. And really just, look at your total investment ecosystem, see what that looks like, see where your goals are, your pain has been, okay, and how we can best help. So just give me a call. If you're in the States, 505-322-7515. And if you are international, +1 505-322-7515. Thank you so much for your time and attention, team. Look forward to working with you all and look forward to the continued honor of helping you all grow your capital in the safest manner possible. Have a wonderful day.